Hello, welcome to a new study unit. Now in this study unit and the next one we turn our attentions to what are the strategic responsibilities of a firm. Now if you remember, we touched on this briefly in the opening study unit when we looked at this question as to what is strategy. And we saw that part of it was about the role a firm, company, has in society, and within that a long-running debate about how the firm generates value for that society. Now in the previous study unit we have focused on to what is called competitive strategy. So our level of analysis has been about the firm, how it delivers to its customers in competition with its peers. And we looked at those four different theoretical views about the source of competitive advantage. But the firm doesn't just operate in a vacuum. It also has to take into account its responsibilities to its investors, to its shareholders, and also the regulations and legal framework that is operating where it is based. Now that interaction between the firm and its shareholders and how value is generated for those shareholders is the domain of corporate strategy. But in that it also looks at how the interests of shareholders might differ from those of management and employees. Now you'll note here that we have shifted our level of analysis. So in competitive strategy, our level of analysis is the firm and its competition within an industry. Whilst for corporate strategy, our level of analysis is from the investor's perspective. That context doesn't just end there. The firm also has a role to play within the wider society in which it's operating, not only in its ability to serve its customers, to pay its taxes and operate within the law, but also in terms of the social value that the firm provides, either through its operations or its voluntary activities directed at wider societal needs. Now that is the focus that we will look at in the next study unit. Now in the strategy and wider literature there are disagreements about where the primacy should be in terms of those firms' responsibilities. One view, the shareholder model, suggests that investors are the prime stakeholder of the firm, and whilst other stakeholders need to be considered as part of delivering value to shareholders, their needs are subsidiary. The other view is that all stakeholders have equal priorities, whether it be employees, customers, government, the local community, as well as shareholders. So in this view, shareholders are just one of many stakeholders where the interests of each have to be balanced. Now this study unit and corporate strategy looks at this question of where value is generated from that shareholder perspective. So the level of analysis you're using to look at things is from how the shareholders perceive the firm. In the next study unit, we'll look at this broader view of stakeholders, and that takes us into debates around corporate social responsibility. That is, the voluntary activities in which the firm engages beyond the needs of delivering value to its shareholders through providing products and services to its customers and staying within the law. Now, different authors are associated with these two different perspectives. Most famously, Freeman championed that broader stakeholder model in the 1980s, while the shareholder perspective is particularly associated with the famous economist Milton Friedman. And let's just look a bit at what he said specifically about the responsibilities of the firm. He said other things about the balance between government and market, but we're ignoring those views. So we're just looking at this question of the responsibility of the firm. Now, he said the responsibility of business is business. So firms shouldn't get distracted by trying to do other things that are beyond their remit. So they should focus on delivering good products and services in a way that enables them to earn a profit, and through earning that profit they are able to reward their investors through dividends and share price growth, and also pay their taxes to government. Now, this is not saying that social value is not important. It's saying that other institutions in society are responsible for delivering social value, that is the government or the actions of individuals, which are enabled by the effectiveness of the firm focusing on what it should be doing. So the earnings allow individuals to engage in philanthropy or charity and so fund social value. And the taxes that firms and their employees pay funds government activity where the specialism exists to deal with those wider needs of society. So what Friedman is saying here is, for an efficient and effective society, then different institutions need to focus on what they're good at, and they stray outside of that into areas that they don't have the competencies, then society will be less efficient. Friedman then goes on to say that, therefore, the job of management is to focus on earning value for the owners of the firm, for its investors, and not be distracted by their own personal agendas that are outside the direct needs of that business in delivering that value to shareholders. So effectively, look to run the business to maximise shareholder value whilst staying within the regulations and rules of that society. So decisions are made to maximise return on investment, and you're focusing on total shareholder return. That is both the combination of rise in the stock value and the dividends paid to investors. And to ensure that happens, then managers need to be incentivised in terms of that value to shareholders. At the same time, this view promotes a more activist set of shareholders who move their capital elsewhere if it's not being effectively used within the businesses that it's currently deployed within. So achieving this within the strategy of an organisation is the role of corporate strategy. So if you think of a typical group business which has a group headquarters and a number of strategic business units, i.e. operating businesses that are targeting different products or markets, looking at the strategy in those individual business units is what competitive strategy is. It's all about competitive advantage. Looking at the strategy about how that group enables those business units to operate under its umbrella to deliver more value to the shareholder is the role of corporate strategy, and the activities of what you'd call the group headquarters or the corporate parent, as it is called. Now, corporate strategy needs to address three fundamental questions. The first one is all about the value being delivered, and that is seeing it from the shareholder's perspective. So is a business unit within the group worth more under its current ownership through that group than it would be worth if owned in a different way, either directly by shareholders or by another parent? Second question is about the composition of that group of businesses. Which of those business units, which of those markets should the group be in? And finally, how do we coordinate that group in its operations across all those different markets? Now, some of these questions are just as relevant to a single line business, that is, one operating just in a single market. Certainly the question of what value is being delivered to its owners, and if that business is thinking about extending its scope, where does it make sense to do that expansion? Now that question of scope takes us into questions of diversification. Now we can look at that question of scope of the group or the business in terms of two dimensions. Firstly, in terms of the supply chain within which the firm is operating in, how integrated is the firm? That means what range of that supply chain does the firm own a part of? Now note, specifically, it is about the ownership of activities across that supply chain. Changes in that vertical scope, if the firm moves closer in that supply chain to the end customer, it's called forward integration. So it's moving downstream in the value chain. If the firm gains ownership of suppliers, then that is called backward integration or upstream diversification in its value chain. To give you an example, we look at auto manufacturing. Well, forward integration would be into the shipping of cars and into the retailing of cars. While backward integration would be into owning component suppliers or even into owning the production of raw materials, perhaps manufacturing steel. Now the other dimension is all about horizontal diversification. And this is how wide a range of products does your firm supply and how linked those are to your core area. So again, looking at motor manufacturing, you might be a family car producer. You're very narrowly diversified as a result. You might have a broader range of cars, all the way from supercars through to city cars. That's an increase in your horizontal scope. But you might go further with that. So as Saab used to do, going into trucks and even into fighter aircrafts. So your product scope becomes wider. Now, why do firms look to diversify? Well, a number of reasons are given by managers to do so. They're looking for growth, they're looking to spread risk, or they're looking to create value. Now there's some problems with the first of these two reasons. Firstly, often growth is pursued for its own sake. And the problem from a shareholder's perspective, if you just grow, unless maintaining the same level of profitability, that dilutes the value being delivered to shareholders. The other problem is that in an efficient capital market, shareholders may well have the option to invest into those firms directly and so don't need you to grow revenue in that manner. In terms of risk spreading, the argument is made by managers that by spreading the operations, it reduces fluctuations within profits. But does that really create value for shareholders? If we look at the performance between narrowly diversified organisations, focused companies on this diagram, and conglomerates, highly diversified groups, we do indeed see that conglomerates do have a more consistent performance. However, that consistent performance comes at the expense of the upside in performance that shareholders would have got with more focused companies. Given that major investors are likely to be diversifying their own portfolios, they are already reducing the fluctuations in terms of returns that they might see. So by the organisation doing it, it is removing that upside within the portfolios of those investors. So again, in an efficient capital market, shareholders don't need firms to do that risk diversification for them. They can do it probably more effectively themselves. And indeed, if you look at the research on who benefits from diversification and spreading risks at the firm level, you see that the shareholders only gain from a small level of diversification where the firm is using its core competencies. Instead, it is managers who gain benefits from wider diversification. It means they're less likely to see downsides in the performance of their organisations, and therefore they personally are at less risk than if they're in a more narrowly diversified business. So from a shareholder perspective, diversification simply for growth or for risk spreading does not create value. They can gain those benefits themselves, certainly in an efficient capital market. So that means that the reasons for diversification from a shareholder's perspective need to focus on to value creation. How does a wider scope create value? How does it create synergy? That is, by bringing in a new business, how is the combination worth more than they would have been if kept separately? And here you're looking at, well, how does that combination exploit economies of scope? How are you able to use internal capabilities, resources, competencies across that wider group of businesses to create value? Or how can you share the skills and expertise again to create more value in the components than they could have done themselves? So the big question here is the group really worth more than the sum of its parts? If it's not, then shareholders would be better off holding investments in those operations as separate entities rather than being combined together into a single organisation. Unfortunately, it would appear that many organisations forget this point. Recent history of diversification is largely one of failures. In the US, between 1950 and 1990, of diversification moves, 50% plus subsequently divested those businesses because they weren't creating value. More recent data from the UK suggested that 60% of acquisitions failed to create the value promised. And indeed, the nature of a M&A process means that largely it is the investors of the acquired firm that gain the value from that acquisition rather than the acquiring firm. We could go on. Skepticism of multi-business firms by investors is shown by looking at market capitalizations. Typically, multi-business firms see a market cap that's 20% lower than an equivalent set of standalone firms. So we need to look more critically at diversification and be certain that ownership of a business unit truly creates shareholder value. Now, into this space comes, again, Michael Porter. and he challenges firms to undertake 3 essential tests before engaging in diversification. Firstly, they do need to do a market attractiveness test. You could say that's obvious, making sure that the targeted new industry is structurally attractive to move into, or at least by your entry you can make it structurally attractive, something you see Cemex doing as it's expanded into new geographic regions. The second test that Porter suggests is the cost of entry test. And this is simply that the cost of entry must not cannibalize future profits. So in an M&A situation, the bid premium, the amount you have to pay above the current value of the shares of that organization, are not more than the synergies and savings that the combined operation can generate. Now again, that sounds obvious, but in the heat of an acquisition, it's surprising how many managers overpromise in terms of those synergies and so subsequently find that the benefits do not match those costs. Now those first 2 tests are quite straightforward. The most interesting one is the third test that Porter suggests. And this comes once the new business is part of the combined group. What Porter says here is that the parent needs to keep on testing to make sure that its subsidiaries continue to be better off under its ownership. So can the parent continue to add more value to the subsidiary than could be captured if that firm is sold to another group or is floated off and owned directly by shareholders? Now, how we assess that question about if and how the parent can add more value to a subsidiary is what we'll pick up in the next video. See you then.